Who's going to get hit by this? It's the speculators.
Yeah.
There's speculators and there's investors. Positive cash flow, debt pay down. That's how I'm making my money. Appreciation is a bonus. The market was appreciating because of investors. The market was appreciating because of a supply issue. If a market were to collapse, it's a race to the bottom. The people with the $1 million houses, sell them and get 750. 750 to 5. 5 to 4. But just because certain properties are being sold at a discount doesn't mean the market as a whole has crashed.
I think we're going to see a reduction in travel, and not just for during quarantine, not just for the next 6 months. I think that this is going to be a long-lasting impact.
What is up, YouTube? Matt McKeever here, and in today's video, I discussed with Kyle Ford exactly what we think is going to happen as in regards to the world of real estate in the future. Now, obviously, no one has a crystal ball. This is just us kind of discussing and speculating a little bit about where we think the market might be headed. Again, we don't have crystal balls, so this is just us kind of discussing our perspective, but I hope you guys enjoy it. Let's dive into today's video.
What is up, YouTube? Matt McKeever here with Kyle Ford, and in today's video, we're going to dust off our crystal balls and just make wild predictions about what we think the future is going to hold. Now, before we even get into this video, it's really important to understand we can't predict the future. No one can predict the future. Anyone that claims that they can, they're either naive, lying to themselves, or they're lying to you. So again, we can't predict the future, but we do pay attention to what's currently going on in the market. And that clearly will impact our perspective and our actions. So we're just going to share with you guys kind of how we're currently acting and why we're acting the way we are based upon what we expect the future to hold. So one, thank you, Kyle, for joining me on this video. Two, thank you for agreeing to just kind of put yourself out there, because I know whenever it gets into predictions or even just thinking about the future, people naturally want to be very judgmental and shoot down anyone that was wrong with hindsight. So this is being shot April 22nd. So again, the world could look completely different by May 22nd. In fact, I'd almost bet money it will, because it sure as hell looked a lot different March 22nd.
Absolutely.
So, thanks for joining, Kyle. And I guess right off the bat, if there's any crazy predictions you want to throw out there, feel free to. Otherwise, I can get us rolling.
80% reduction in market pricing. No. You lead, Matt. I mean,
so
you nailed it. So.
I'm going to kind of build upon what you literally said there, Kyle. You know, the people that are like, real estate's going to tank. And don't get me wrong, I get a lot of angry commenters or emotional commenters. Maybe I should call them passionate commenters on my YouTube channel, telling me what a fool and every guest on my channel is because real estate's going to zero. In a previous video Kyle and I shot, Kyle alluded to the fact he didn't expect to see, you know, the small multifamily properties in southwestern Ontario plummeting. Neither do I. And I'd love to hear Kyle's perspective, but I'll share first my perspective. When I'm looking at rental properties, particularly in southwestern Ontario, the market I invest here in London, Ontario, I'm investing for affordability and based upon fundamentals. So I'm only ever investing in properties that either cash flow or have a clear path to cash flowing over a short period of time. And the reason I'm confident that I'm going to continue to see that cash flow is what I like to focus on, which is my tenants' affordability. So here in London, the average 1-2 bedroom apartment, probably $1,000, $1,200 a month, maybe $1,300 or $1,400 a month for a 2-bedroom if you're starting to get a bit on the higher end of the range. Well, when I look at minimum wage here in Ontario, Canada, it's $15 an hour. If you're working full time, that's considered to be 2,000 hours a year. That means you're earning about $30,000 a year as a minimum wage full-time employee. Now, Stats Canada shows us that the average Canadian spends about 30 to 40% of their income on shelter. Now, that tells me that average minimum wage employee, they can afford to spend $10,000 a year on shelter, or about $800, almost $1,000 a month. So when I'm looking at, well, I'm going to rent out my 1-bedroom apartment for $1,000, and I know one full-time minimum wage employee could live there, and they could essentially afford the rent by themselves, that's what gives me confidence to move forward. And in particular, one of the reasons I'm confident in our minimum wage rate is any politician that tried to mess with it is messing with a big part of their constituents, right? They're messing with a big part of the voting public. And I think that would literally be political suicide in any sort of active democracy. So when I hear people throwing around 80% reductions in fair market value, I'm like, well, is this also going to reflect an 80% reduction in rent prices? Because right now, before COVID-19, we were going through a vacancy crisis here in Southwestern Ontario. So London was rocking like a 2.2% vacancy rate, which means that there really wasn't an excess of inventory available for rental properties. So that's kind of my sleep at night factor. But I'd love to hear, Kyle, your perspective on why you're not panicking, why you're not selling off all your multifamilies, why you don't think we're going to see that 80% price reduction.
So in terms of who's going to get hit by this, it's the speculators.
Yeah.
There's speculators and there's investors. If the only way you make money on real estate is the property value goes up by passive appreciation, just the market appreciating, and and you're negative every single month, you're in big trouble here. That you are. Now, I don't buy properties based on that way. I buy it based on income, expenses, and being able to produce a positive cash flow on a monthly basis. Positive cash flow, debt pay down. That's how I'm making my money. Appreciation is a bonus. Now, can we naturally force appreciation by increasing rent? Yes, but that's not a strategy that I'm going to be focusing on in these times. In terms of the crystal ball, you nailed it with the vacancy rate. Everybody, the general public talks about how the market was appreciating because of investors. The market was appreciating because of a supply issue. It was undersupplied. We didn't have the vacancy rates were low. There wasn't enough new construction. Immigrants were pouring in here, which was what was driving the market up. Now, immigrants maybe aren't pouring in now because the borders are closed, but I've heard no plan of that stopping once the borders are reopened. So I'm not predicting a crash in the market. I'm certainly predicting a softening in the market. So values staying where they are, maybe small decreases on high-end single-family homes. If your business was flipping luxury homes in London, $2 million homes in London, I'm a little bit worried for you. But if your business is acquiring $200,000 homes and renting them out for $1,500 a month, I think you're going to be okay throughout this. I don't think we're going to see a dramatic value. If a market were to collapse, it's a race to the bottom. The people with the $1 million houses, sell them and get 750, 750 to 5, 5 to 4. And then what starts to happen is the new people who are sitting on the sideline waiting to get in the market are now coming in at the entry level and keeping that buffer, that safe haven. So I'm not predicting a crash in the market. I don't think the market's going to crash. I think it's going to pause. I think it's going to slow down. I do think that certain people who are highly leveraged, whether that's a consumer who's gotten into some trouble with debt or an investor who's over leveraged, I think they might be in a position that they need to panic and sell their property at a discount. But just because certain properties are being sold at a discount doesn't mean the market as a whole has crashed.
Yeah, absolutely agree. And I'd love to build upon that and then get your feedback as well. Yep. So for me, when people people want to know where's there going to be blood in the streets. And so if I had to predict where I think there could be blood in the streets, it is in luxury homes. It's in, spec builds or spec flips. It's in pre-construction condos, things of that nature. And I'll explain why. For example, here in London, Ontario, if you were in the luxury homes over $1 million, if you can't get CMHC insurance on that entire mortgage amount, that's concerning to me. Because one, the buyer pool in London for $1 million plus homes, it was already razor thin. There wasn't a ton of inventory changing hands during the best of times. So the moment uncertainty or volatility gets added to the equation, I don't see why we'd see an increase in demand or an increase in money flowing to that asset class. The second is like spec builds. So again, if you were building homes, brand new homes without an in buyer already lined up, that's concerning for me for a multitude of reasons. We're getting squeezed on the actual construction side of things. Simply, it's harder now to do the work that you were going to do. But secondly, obviously the buyer pool could start to dry up as well. And there's going to be a lot more competition now. There's simply going to be more more properties available, likely at lower prices or softer prices. So we probably aren't going to see as many bidding wars and things of that nature. So again, I think that that's going to create some softness or weakness in that asset class. I suspect here in London, we probably will see some luxury home builders really struggle and potentially even have to go into bankruptcy. Again, that's just a prediction. It's not a crystal ball. Like, I can't guarantee that these things are going to happen. But like Kyle was saying, if your business model was solely based upon what's called the greater fool theory, where you're just like, hey, I got something. As long as there's someone stupider than me that's willing to pay more, I'm set. That's a very concerning business model, because that stupid money isn't out there the way it used to be. Like a few months ago, there was a lot more stupid money just washing around the markets. It's starting to be absorbed because of all the craziness that's going on, and people are starting to be a bit more protective of it. As well, pre-construction condos, they were already concerning for me personally, just because I didn't understand the investment strategy other than the greater fool. But now that you add additional volatility, uncertainty, we could eventually see certain governments move towards more nationalistic or jingoistic policies, where like they may want to reduce foreign investors or, foreigners coming into a country. And all that is concerning, because I think that in the pre-construction condo market, that wasn't an insignificant influence in that asset class. So things like that are definitely areas where I'd want to be extra cautious. The other one is in commercial real estate space. So if I'm renting out to mom and pop stores, if I was renting out to like dine-in restaurants, things of that nature, I think that we're going to see, this is a prediction I'm more confident in making. I predict we're going to see massive changes in consumption and behavior patterns for the average person. So one of the things I feel comfortable saying is I think we're going to see a reduction in travel, and not just for during quarantine, not just for the next 6 months. I think that this is going to be a long-lasting impact.
Cashflow Tribe. I decided to come to boot camp and see what it's all about, and I'm glad I did. The way Ben and Matt delivered their product, they're investing in you, and you want you to invest in yourself too. Getting your mind right, giving you the clarity, that for me was already worth the price of admission. Even if you think that you know everything about real estate, you don't. Like meeting new people, like you always hear different stories. And like having 15, 20, 30 people with different mindsets. They have different experiences, like that's so powerful. And meeting this people, like for me, it's priceless. It's priceless. 2,500 doesn't even come close. When you look on the internet, you can find all the strategies you want, but when you have the connection with the people that are doing the same thing as you are, it's just extremely powerful.
You have to surround yourself with people that have the same goals, or they want to talk about the same stuff that you like. And sometimes just with my friends or my family, they just try to talk me out of this. They don't believe it's going to work, so I have to relate myself with people that believe in the same things that's going to work and we can do.
I predict we're going to see massive changes in consumption and behavior patterns for the average person. So one of the things I feel comfortable saying is I think we're going to see a reduction in travel, and not just for during quarantine, not just for the next 6 months. I think that this is going to be a long-lasting impact, where people are going to question whether they need international travel the same way they needed it a year ago. I think that we're going to see people return more to your home as your castle. I think that we'll see things like home theaters on the rise. I think we'll see more investment in big screen TVs and things of that nature, and that people will really want to create their own little oasis at home. One, potentially out of fear that this could happen again and they may be stuck in their home. Two, because we're going to be under quarantine long enough that it's long enough to set new habits, right? Depending on who you ask, they say it takes 3 to 8 weeks to set a new habit. Well, either way, no matter how you slice it, we're essentially going to be social distancing for that period of time or longer. That means a lot of people will change their habits. A lot of people that weren't necessarily forced to learn how Uber Eats works or Amazon or Netflix works, all of a sudden, like, in my opinion, my parents' generation, they're being forced to figure this shit out, because the choice is stand in line at the grocery store for 3 hours in order to get your rations, or just order on Amazon and get delivered next day overnight. And I think that we'll see a lot of people embrace that and that will unfortunately impact a lot of mom and pop shops, especially those that were deemed non-essential. And again, because people will have built new habits. They're no longer in the habit of going to that vegan cupcake store. They're no longer in the habit of going to the local bistro and just sitting there and having that $5 or $10 coffee. And so things like that are the areas where I think there's the greatest softness. Like Kyle was saying, I think the real safety is in starter homes. I think, like, if you were to ask me one asset class that I think is very safe, it would be starter homes in affordable cities like London, Ontario. Our starter homes were maybe in the threes. How much compression are we really going to see on that price? Because one, we had pent up demand from people that were scared they were never going to be able to afford a house in their lifetime. Think about it. 6 months ago, we had all these news articles about how millennials and Gen Z were never going to be able to buy their own house. Those people, they've still got that mentality. And so those of them that still have their jobs and are able to buy, I think will buy as well. Like Kyle said, the people in higher price brackets, they get pushed down. They don't decide not to buy a house. They simply decide to buy a different house. And the house they buy is probably going to be more in the starter range. So if anything, I think we'll continue to see a lot of competitiveness, at least in my local market, in that $300,000 price range for a single family house. Anything you'd like to add or build upon kind of my monologue there, Kyle?
Yeah, 100%. And the realtors that I talk to, same thing. In Kitchener-Waterloo, if you're under 600,000, your house is selling still. People still are looking for housing. There's obviously the people who have committed to transactions that need to move, but there's people who have moved to the area, were renting, or were a young person who never thought they could buy here, and they're saying, like, this could be my chance. I could buy it. I work for a tech company. I'm still employed, so we're able to move forward there. I want to jump in. We're in that timeline here of one of the greatest shifts of wealth is started and is going to be continuing occurring as the baby boomers are retiring. Those same baby boomers are also the ones that have maybe been reluctant to learn technology and learn about the new ways to do things. And there was this, and I'm going to use my mom as an example. She's terrified of apps. She doesn't know like anything app. And not appetizers. I love those, but the technology apps. So she was terrified of them, but she's learning to do that now because out of necessity, she has to. And now that she's overcome that fear, she's like, oh, this is great. I thought I could only order pizza. I can order everything. I can order anything I want. And I can see where the guy is and all this and all that. So I think that those changes are going to lead into the result of the commercial business real estate. I've talked to several business owners who are up and running right now. Employees are active and everything's moved to virtual at home. And they're sitting there going, business is fine, even in the pandemic. Productivity, right where I need it to be. Why the hell am I paying for this office space? What am I paying for? So I think we will see a transition in how businesses are operated, which can have an impact on the commercial real estate game. But I'm always that once again, because we're playing the crystal ball game. I always say never take advice from a skinny chef. I'm not a commercial real estate investor, but I think you and I are both relatively, knowledgeable on all elements of real estate. And crystal ball prediction is commercial real estate's going to get hit here. It's going to be hit a lot harder than the residential stuff.
Yeah, and I actually forgot to mention office space. I appreciate you saying that. Again, one of the things that's like from a dispassionate, unemotional perspective that's fascinating about this whole thing to me is how a crisis can really force us towards innovation, how it can force us to lean in. Companies were already moving towards, shared workspaces, and they were already moving to being able to virtually commute. But this has just sped up the timeline so much faster that I feel like in the last month, we maybe experienced a decade's worth of innovation in regards to work from home. And so I think once you let Pandora out of that box, it's impossible to get the genie back into the bottle. And so I think that that's here to stay. And I think that with these virtual business practices, again, companies are going to start to learn, just because I'm based in Toronto doesn't mean every one of my employees has to live in Toronto. And so we may start to see more what would I call it? I guess more flexibility for the average person in regards to where they can geographically be located, just because as businesses continue to embrace virtual business practices and learn how to optimize and get the most out of their employees under this new dynamic and situation, I think that they'll just become inevitable that they'll want to lean into that.
I totally agree. Totally agree.
Okay.
And I think, I don't like beating up Toronto, but I've never liked investing in Toronto. I've always, my philosophy has always been about a 2-hour commute from Toronto. Drive till you qualify. Drive till it cash flows is kind of the mentality that I was given. And you're absolutely right. Some of these big companies in Toronto, they might say, this works great. You can work from home now. So those condo owners in Toronto, are they going to look at moving to the more, the Barries, the Peterborough, Hamilton, Kitchener, London? Is a market like London going to get more of those people now because it was kind of uncommutable? 2 hours both ways is pretty tough. But if I only got to commute from London once a week to Toronto and I could buy a beautiful home in London versus a condo, maybe I'm going to relocate. So we could not only see some rejigging of businesses, but people maybe moving out of that high price points in Toronto and saying, I can still keep my downtown corporate job. I'll drive in once a week and work from home the other 4 days.
Yeah, absolutely. Now let's move towards part of our crystal ball game that I think a lot of my audience is going to enjoy more. So one of the things that I personally think we're going to see a lot more of in the near future is VTBs and the ability to get VTBs. And I'd love to get your perspective, Kyle, but I'll just first share high level why I think we'll see a lot more VTBs. I think sellers, they really like the prices that properties were selling for a month ago. I don't think that they want to give up that reduction. And especially once we start looking at multifamily or investment properties, I don't think those investment owners, let's take London, Ontario, my backyard. The most recent comps, right as COVID just started happening, properties were selling for as high as $160,000 a unit here in London, Ontario. I think that there was a lot of apartment owners that saw those comps. I don't think that they're going to want to walk back to $130,000 a unit or $125,000 a unit. So I suspect that we'll see a lot of sellers be willing to turn their equity gains into VTBs in order to still get those high prices in regards to selling their property. But that's just my opinion. I know, Kyle, you've had a lot of experience with VTBs. What are your thoughts?
I couldn't agree more. I think one of the things VTBs has given me is the ability to pay more for a property.
Yeah.
If you're holding my financing and I have to put less money down, I'm willing to pay you more for the property. So in this scenario, I think that's. I don't really have anything to add. You nailed it there. The other part of that too is before they were maybe looking at their real estate and saying, okay, it was worth $160 per unit. My rents are low, so maybe I should just sell. My stock portfolio has actually been doing really well. I'm making good money there. I'm making 10%. Well, now their stock portfolio is not doing well. So when they sell their property, what are they going to do with the money? So it's the combination of, yes, we can pay more, but they don't feel safe. They might not feel safe putting it elsewhere. So if you can offer a secured, consistent income return through a VTB, I think they're going to be more attracted to it because there's certainly less confidence of moving their money elsewhere.
Yeah. Another thing I'd love to pick your brain on, Kyle, is what do you think about, I'm just going to call them the baby boomers, but essentially anyone that's hitting retirement age right now is a real estate investor. I personally, I only have anecdotal evidence for this, so this is maybe me getting a little bit more out on a ledge, but I suspect a lot of them are going to decide to sell in the near future if they can still get yesterday's prices. So I think that they're going to look and say, a month ago or 2 months ago, they were probably like, I wonder how high this shit is going to go. I'm going to keep waiting and just see, how high we can really take prices. Where I think now a lot of the smarter investors that, are getting close to retirement age, they're probably looking at it and being like, the next year and a half, I'm not sure if I'm going to see a lot of appreciation. So if I was planning to sell in the next 2 years, I'm probably just as well off to sell today and get it over with and be done and not risk rent strikes anymore, rather than try and wait 2 years and probably sell for around the same price.
Yeah, you nailed it again. The one thing I saw a Facebook meme about this the other day too, and I've always said this: we as younger investors, as people who have learned through social media, learned through mentorship, and learned through training, and all those things, it's amazing the knowledge that some people have before they buy their first property already. Most of these people that own these bigger buildings are not trained investors. They've never invest. It made sense back in the day, and they bought it, and they're landlords. It's their job. They work on the building. They live in the building. It's their job. So, and that's a bit of a blanket statement, but in my experience, that's what I've seen. So I do feel that exactly what you said. They're not trained as investors. They've been through ups and downs. They've been through downs that have lasted a lot longer. I don't like to praise the government and everything they do, but the government has learned how to quickly stop the bottoms. They stimulate, they dump the money in, and I'm not an economist, so I don't claim to know everything, but they've learned how to speed these downs up. So, but these owners of these buildings are looking at the building and saying, listen, I don't think it's going up anymore. I got a job here, and if I can get an income from it through a VTB, I can sell it now for what it was. This new hotshot young kid is going to buy it for what it was worth a month ago. What an idiot! I'll get rid of it now, because we're in it, and as long as you're in it for the long haul, and you're holding for 5 years, you're holding for 15 years, you're holding for 20 years, whatever that is. Even if there is a short-term downturn, you're not going to be affected by it. Rent out the building, cash flow it, and hold it for the long term. But the biggest part of that is, I think as younger investors, and I'm 30, so I think a lot of people who are watching this maybe under 40 years old. Yep. We think that these 60-year-old building owners are these savvy, really, really knowledgeable, trained investors. And most of them do not have the amount of knowledge, and that's not to knock them. They've done well for themselves, but the way they learned it was as a job, where we're learning it as a business. So their perspectives are different for us, and I think it's important for us to recognize that. Yeah,
absolutely. That's a fantastic point. Any other predictions that you'd like to make? A reminder: this is a safe space. You're allowed to wear your tinfoil hat if you want, Kyle. So if there's anything else before we wrap up, I'm definitely happy to hear it. But otherwise, just been a pleasure getting to catch up.
Yeah, you know what? I think we're going to see some people get taken out by this. I do. I think there's some people that have been, not doing this business the way it needs to be done. So I do think that we're going to lose some people to this. But I think everybody who's investing in education and training and learning how to be an investor, not a speculator. The people who are treating their tenants like the best clients out there, because they're your clients, they're your customers, treating those people like gold, and the people who are, when they are buying, making prudent decisions, and based on economics or economic indicators and all good property values, I think they're going to do just fine. And I think as a whole, as long as we're in this business for a long term and you're not going to sell, panic and sell, I think there could be some great buy opportunities. So
awesome. Love it. Thanks again, Kyle. Cool. And we'll see you guys in the next video.
Thanks, Matt.
Thanks again to Kyle for taking the time to shoot this video. If you guys enjoyed this video, smash the like button, hit the subscribe button if you're new to my channel. I'll see you guys in the next video.